I see this all the time. A client sits across the table from me and they're not in trouble. They're not panicked. They're not even behind on their bills or buried in credit card debt. These are high earning professionals, W-2, maybe some 1099 income. They max out their retirement accounts, they track their net worth. They're really doing all the things everybody tells you you're supposed to do. And yet somewhere underneath all of that, there's a question that they just can't quite shake. Am I actually doing this in the right order? And here's what I've learned after years of sitting at that table. Most of the time, they're not wrong to ask. They're actually doing almost everything right. But there are a handful of invisible mistakes that show up again and again. Mistakes that don't feel like mistakes in the moment. Mistakes that on paper look like really good decisions. And in this video, I want to walk you through 4 of them. Not the obvious stuff. Nobody's blowing their paycheck on crypto or forgetting to save altogether. These are the mistakes that smart people make. People that are 80 or 90% of the way there. Let's just fix that last 10%. So the first money mistake is something I see constantly, and it almost always comes from a good place. You're a high earner. You've been told your whole career, put as much as you can into your pre-tax 401k. Lower your taxable income now, let the money grow tax deferred, and pay taxes later when you're retired, and presumably in a lower tax bracket. But here's the thing. That logic made a lot of sense when you were making like $80,000 a year, but it starts to break down around $250,000. The problem isn't the saving. The saving is great. The problem is that if everything you own is in pre-tax accounts like your 401k, your traditional IRA, maybe even old rollover from a previous job, then every single dollar you pull out in retirement is going to be taxable income. And if you've been maxing out that pre-tax space for 20 to 25 years, you could be looking at a 7-figure balance that's entirely tax deferred. So here's what this actually looks like. Let's say you're married, filing jointly, and you've got $2 million in pre-tax retirement accounts. At a 4% withdrawal rate, that's roughly $80,000 a year, which by itself keeps you in a reasonable tax bracket. But now add Social Security, maybe a pension, maybe you sold a business or have rental income on top of that. Suddenly you're not in the low 12% federal bracket you imagined. You could be pushing into 24% or higher. And if tax rates continue to go up between now and then, which frankly a lot of people expect that they will, you could be paying a higher effective rate in retirement than you would have paid just doing Roth contributions along the way. The fix isn't to stop contributing to your 401k, the fix is tax diversification. If you're in the 24% or 32% bracket today, having even 20 or 30% of your total retirement savings in Roth accounts, whether you're Roth 401k at your employer or a backdoor Roth IRA, gives you a tax-free bucket to pull from. That flexibility means you can manage your taxable income year by year in retirement instead of being at the mercy of whatever bracket your pre-tax withdrawals push you into. It's not about avoiding taxes entirely, it's about having options when you pull your money out. The second money mistake is less about what you're doing and more about the sequence you're doing it in. I see this one especially with parents. You've got young kids, you're responsible, and you want to get a head start on college savings. So you open a 529 plan and you're putting money in every single month. You feel like you're doing the right thing for them, and you are. But here's the question I always ask. Are you maxing out your own retirement accounts first? Because there's a hard truth that nobody really wants to say out loud. And I get why, I'm a parent myself. But it's this, your kids can borrow for college or figure it out if they have to. You cannot borrow for retirement. Now, I'm not saying don't save for college and don't plan for it. I'm saying there's an order to this process, and the order matters more than most people think. So here's the waterfall, and this is what I walk clients through all the time. Step 1, do the 401k contributions up to your employer match. That's free money. Don't leave it on the table. Step 2, fully fund your Roth IRA. If your income's too high to do direct contributions, the backdoor method definitely makes sense. Step 3, now go back to your 401k and let's max it out to the full limit. Step 4, we're gonna max out your HSA if you have a high deductible health plan and you qualify to make contributions. You get a triple tax advantage here. It's tax deductible going in, it's tax-free growth, and tax-free withdrawals from medical expenses. It's the best deal in the entire tax code. Step number 5, then and only then, use the taxable brokerage, 529, and all the other types of accounts. If you're putting money into a 529 plan or a brokerage account before you've maxed out your tax advantage space, you're leaving money on the table. And for high earners, that's a 6-figure mistake over an entire career. It's not that the 529 plan is bad, it's just the sequence that makes everything work well. The third money mistake is subtle. It doesn't feel like a mistake at all when you're in the middle of it. Here's the scenario. 10 years ago, you were making $125,000 a year and you were saving 15% of your gross income. Solid, respectable, probably better than most of your friends, to be honest. But now you're making $250,000, maybe $300,000, and you're still only saving 15%. So here's what happened. Your income doubled, but your savings rate stayed exactly the same. And because your lifestyle expanded, and look, I'm not talking about boats and sports cars and all the flash, you upgraded the house. The cars got a little nicer. The vacations got a little nicer. Private school for the kids. All perfectly reasonable choices. But here's the math. At $125,000, saving 15% is around $19,000 a year. At $250,000, saving that same 15% is $37,500. That's good, but here's what I want you to think about. What if you'd kept the percentage at 20% or 25%? At 25%, you're saving $62,500 a year versus $37,500. That difference is 25 grand a year. Over 15 years at 7% return, that gap is over $600,000. That's real money we're talking about. Now, I'm not saying don't enjoy your life. I'm not saying live like you're still making $125K. What I am saying is there's a rule that I share with clients that helps us enormously. Every time your income goes up, bonus, raise, new job, take half of the increase and direct it to savings or investments. The other half, enjoy it. Hey, you earned it. What that does is it lets your savings rate actually grow with your income instead of staying flat while your lifestyle does all the growing. Now, this fourth money mistake might be the most expensive mistake on the list, and it's the one that nobody sees coming because it doesn't feel like a mistake at all. Here's what happens. Every March or April, you gather up your W-2s, your 1099s, and hand everything off to your CPA or enrolled agent. They file your return. You pay what you owe, if anything, or maybe you get a little bit back. And you think, taxes? Handled. But here's the thing, what your accountant just did is called tax compliance, filing what already happened. What almost nobody is doing, and what your accountant probably isn't going to bring up unless you ask, is tax planning. And the difference between those two things over a career for a high earner can be enormous. Tax planning happens in October, before the end of the year, not April. It's things like, should I be doing Roth conversions in years where my income dips? Should I be bunching charitable contributions every other year to push past the standard deduction? If I've got 1099 income on the side, am I structured the right way, or am I paying self-employment tax I could legally reduce? Let me give you a real example. I had a client a couple of years ago who left their corporate job mid-year to start a consulting practice. Lower income year by design while they built the book of business. Nobody had told them before that this was the perfect moment to look at a Roth conversion. You could convert $100,000 of pre-tax money and pay almost nothing in taxes on it, then let it grow tax-free for the next 20 years. We called it just in time, but if we hadn't been talking proactively, they would have missed that opportunity. And that window doesn't reopen after December 31st. Your accountant's not going to call you in October and say, hey, let's do some tax planning. That's not how the model works. You've got to initiate that conversation or work with someone who makes it part of the ongoing relationship. So bringing it all together, here's what I want you to notice. Not one of these four mistakes is about picking the wrong stock. Not one of them is about missing a market rally or timing the next downturn wrong. Every single one of them is about order, structure, and systems. Tax diversification, that's the architecture of where your money lives. Order of operations, that's about sequencing. Savings rate, that's about the discipline to grow your habits as your income grows. Tax planning, the fun part for me, that's about being proactive instead of being reactive. High earners don't fail because they're bad with money. They fail because they treat financial planning like it's just about earning more and saving something, when really it's about the architecture around what you've already built. If you've made any of these mistakes, and let's be honest, most people I meet have made at least 2 or 3, you're not behind. You're not failing. You're just doing things slightly out of sequence. And the fix isn't earning more money. You're already good at that part. The fix is taking the income you've worked hard to build and putting the right structure around it. That's what turns high earnings into actual wealth. If this resonated with you, subscribe. I'm helping high earners stop guessing and start building. We drop a new video every week, and I'll link a few in the description that might be helpful. Remember, stay the course, and we'll see you next time.